Even as short-term rates remain at double digits, large banks are looking at cutting lending rates on some segments. Banks like SBI, HDFC Bank, ICICI and other large PSU banks have significantly larger balance sheets and are in a better position to take advantage of the recent cut in cash reserve requirements.
As you reduce CRR and say if you get another 100 basis points reduction in CRR, the banking system's cost itself will go down and you will see a reduction in interest rates. As long as the RBI, and that's where their actions are moving, ensures liquidity, you will move to a lower interest rate regime and he can cut the policy rate when he's comfortable.
The central bank has made it clear that inflation is still a threat and indicated that it may be a while before policy rates come down, something that makes it impossible for bankers to tinker with their base rates. Instead, banks are looking at cutting rates in certain segments like auto, SME and some corporate loans.
At least productive sectors and some of the priority sectors like bank like IOB, we are already kept our rate. Suppose for housing or vehicle loan or educational loan or some of the priority sectors we have kept it already low. So that sectors we may like to give benefit. To that extent some reduction rate can be reduced.
Rates in the money market have spiked since the budget. Smaller banks are still hard pressed for funds and are being forced to raise FDs at rates as high as 10%. The stage seems to be set for large banks to take advantage of easing cash conditions to boost their credit growth. Simran Gill and Anirudh Ghosh, ET Now, Mumbai.